Hello, my name is Patrick Scholl, and I'm a partner and head of banking and finance of Mayer Brown in Frankfurt. On Wednesday, 24th of June, we held our 6th OTC Derivatives Seminar under the title Managing Crisis and Transition. Due to the corona crisis, we held this seminar this year as a WebEx conference. This year, we offer you the opportunity to watch a recording of our seminar. The speakers during the seminar have been my partners Anna Pinedo from New York, Chris Arnold and Ed Parker from London, and myself, Patrick Scholl. In this specific year of the corona crisis, we couldn't leave the impact of the pandemic on derivatives and master agreements aside. In this part of the recording, you can watch our presentation on impacts on derivatives and on preparations for defaults under master agreements and credit derivatives.
Thank you, Patrick, and thank you all for your questions so far and engagement. We've managed to get through nearly 100 minutes of our seminar without mentioning or hardly mentioning the two big topics at the moment, and the ones why we're having to do all this so remotely, being COVID and then obviously Brexit. We have some slides on Brexit at the end, so I don't want to take too much time on this session, but I did just want to spend the next 5 or 10 minutes or so just flagging some of the issues that we have seen raised since March and the in relation to the global lockdowns for the COVID pandemic. I mean, I think the good news is that the ISDA master agreements and the ISDA architecture has performed pretty well, but there has not been the amount of stress perhaps on derivatives agreements, at least on closeout arrangements, as we would normally expect given the huge economic impact of COVID. So this slide just contains a summary of some of the issues that have been under discussion that our clients have come to us with. Just to run through the list just briefly. So force majeure, many of you will recall that the 2002 master agreement has provisions dealing with force majeure, which effectively allow parties to early terminate their contracts and calculate closeout amounts. Those provisions are not found in the 1992 master agreement. So one of the earlier questions was, could there be situations where this force majeure clause could be invoked if our counterparties are not able to pay because of COVID and the situation on COVID? And this is an important question because whether a failure to pay is caused by not having the money to pay or not being able to pay because you don't have the infrastructure or the ability to pay has consequences for the timings for closing out and potentially the amounts that are payable on closeout. So these were important questions at the time. And I think although I'm not aware of any contracts being closed out for the force majeure yet, I think this was a useful discussion for us all to have as lawyers, because there's never really been much of a test of the force majeure provision of the 2002 master agreement, and it was introduced in the wake of the 9/11 attacks, which caused certain market infrastructure to be closed for an extended period. So just to summarize, really, I think the main finding, or the main conclusions that we as lawyers reach from an English law perspective, is that there may be possibilities in which the force majeure clause could be invoked as a result of actions taken in light of COVID-19, although the facts and circumstances are very specific as to when that might be the case. So there's not a sort of blanket exemption or blanket right to terminate just because there is a pandemic and it's causing us all great disruption. As a counterparty, you have to genuinely be able to demonstrate that you are not able to make payments or deliveries under your transactions. And that could be an example, might be all of your personnel are absent and are incapable of making the relevant payments or sort of similar sort of high burden. So, and that's largely the reason why we haven't seen that being invoked, is because of the very high threshold. There's also the English concept of frustration, which essentially means, does this make our contract effectively impossible to perform or frustrate the purpose of our contract? Again, there were discussions around that, that if anything is an even higher burden of proof than force majeure is, so it's unlikely to be relevant so far, at least. Other issues, so unscheduled holidays and market closures, there were a number of, right from the early emergence of COVID-19, there have been a number of shutdowns of markets, temporary shutdowns, as the virus has moved through different countries. The provisions dealing with those are largely product specific and depend largely on what the relevant markets are, what has to happen, what the closing effects are, and so on and so on. So we've got a lot of questions on those, but by and large, those have been able to be resolved in accordance with the terms of the relevant set of ISDA definitions or the terms of the contract. Emergency insolvency legislation is a kind of, I put it there because it's really a watching brief. Many jurisdictions have been implementing or in the process of implementing new insolvency legislation to help protect their economies and protect businesses that would be viable but for the COVID-19 crisis. The main impact potentially of that for derivatives contracts is, of course, on closeout netting and collateral opinions, and making sure that none of those new insolvency measures could potentially impact the clean netting and collateral opinions that we have in any of these jurisdictions. So we're in the process of the English insolvency provisions being updated and watching that very, very closely. So I would expect in the next round of ISDA industry opinions on this in this regard, there will be consideration of some of these changes that are made in various jurisdictions. Payment moratoria, this relates principally to derivatives that are hedging debt obligations such as loans and bonds. And I mention it because there may be situations where there is a moratorium on enforcing payments under those kinds of instruments, but then your payment obligations are hedged using interest rate swaps or caps or other products. And so it's just worth being mindful of the fact that although those moratoria may provide the borrowers with some relief in terms of their obligations on those debt instruments, they may not necessarily extend to payments on derivatives contracts, so may provide limited relief of themselves from derivatives. One issue that came up, which I was very interested in light of all of our discussions on initial margining and regulatory margining more generally. Of course, regulatory margining was designed to make the system safer in the wake of Lehman Brothers and others, and to try and remove any of that kind of systemic risk that was involved in having these large institutions being at the center of all of these derivatives contracts. What was really fascinating back in early March, at the sort of height of the financial markets element of the crisis, is that we had a situation where derivatives contracts mark-to-market values were moving out very rapidly. At the same time, we had a situation where the price of very safe government bonds and the kinds of collateral that's being posted under CSAs and regulatory margining arrangements was falling in value quite significantly too. So there was a huge transfer of margin, which really, I think, tested the system to its limits in terms of the ability for parties to find and that collateral and post it to their counterparties. So it'd be interesting, I think, to see whether the regulators look at that situation in the context of things like the initial margin models and the variation margin rules, as to whether there could be improvements to avoid that kind of pro-cyclicality for margining, where by designing this system to be more safe rather than less, we don't inadvertently create more problems where we have these huge market-wide events. And just finally, from a practical perspective, I'm sure many of you, if not all of you on the call, have been grappling with the concepts of electronic signatures over the last few. Certainly here learned an awful lot about all of the relevant legislation on electronic signatures, because it's been a very practical aspect of our lives in terms of continuing to coordinate closings in the context of derivatives and other transactions. So that's another important issue for us. So I just want to move on briefly to the next slide and touch on credit derivatives. Credit derivatives has been a big part of my career for the last nearly 20 years. I'm always fascinated by the responses in the credit derivatives market. The first bullet point on my slide refers to this 2.6 billion big short, which is what the FT described Bill Ackman's credit derivative play in the early part of the crisis, where he realized a profit of $2.6 billion reportedly on buying protection on credit derivative indices, the CDX ITRAC indices. He took a huge position on those very well. I think back in February, he ended up paying, I think they said about $14 million, as was reported in the FT, of premium for those contracts that would be stretching out 5 years. In that period of time since he put the contracts on and when he unwound them or transferred them to other parties, the spreads on CDS just ballooned, and he was able to make $2.6 billion as a result of the change of those positions from an original premium payment of just $17 million. So a phenomenal result, and just goes to show really the positions you can take in CDS and the potential impact of market developments on those positions. It was a very high risk bet. He could have, things had not gone the way he suggested. He could have been sitting paying premium on those contracts for many years. And the reason I flagged that is because I just wanted to use that as a framework for asking the question really as to what were the people who paid him $2.6 billion getting good value for money in allowing him to unwind those contracts at that point. And really that comes down to, are we going to see the level of credit events in the market as a result of this COVID-19 epidemic that were expected at that point? And the other great factor in the value of credit derivatives contracts is what is the realized, and what are the realized payments going to be upon those credit events actually occurring? So interestingly, since the outbreak, or since the height of the crisis back in March, there've only been 12 CDS credit events globally. 9 of them have been in the US, and 3 of them have been emerging market sovereigns. There have been 0 European credit events, which really I think is a remarkable statistic at this stage, given the huge amount of economic inactivity that has been across Europe over the last 3 months and the industries that have been suffering. Why is that? Well, a number of reasons. One is that we don't have the similar kind of Chapter 11 process in many of the jurisdictions in Europe that make it easier for entities to file for insolvency. Another is, of course, the unprecedented support that governments have been giving to industries, particularly the travel hospitality industries across Europe, in order to try and maintain those operations as viable throughout the crisis. And interestingly, some of the restructuring activity that we have seen has been done in a way that hasn't triggered credit events, either because it hasn't led to restructurings of existing debt that would cause those credit events, or has happened in a way that is not being made public in a way that would be required in order to trigger credit events. So on the one hand, so far, I mean, I think it's very much early days, but so far we haven't seen the sort of mass credit events going on in the last 3 months. But one interesting issue is actually the credit events that we have seen. The auction final price, which is the process which determines what the payout on those contracts is, has been really historically low. So across those 12 credit events, the final price has been just 22.9%, and that essentially the protection payment that is made is 1 minus that amount multiplied by the notional amount of protection. So you'll see the payouts on those entities, on those contracts, have been quite a lot higher than traditionally has been the case, where the recovery rate has been 43.2% on all credit events. I think that may show a number of things. I think one of the things it shows the trouble that the actual entities that have been allowed to go bankrupt have been in companies like JCPenney and Hertz, the rental car company, companies that were perhaps not in the best financial shape before all of this happened. and obviously their bonds obligations have fallen in price hugely as a result, and those recoveries have been very low. So that's all I really wanted to say about credit derivatives, but I think it's going to be very interesting over the next few months to consider some of the further measures that are taken to help support these companies, and whether the CDS contracts work as they're expected to work, and whether indeed those contracts turn out to be worth the $2.6 billion that Mr. Ackman was able to realize for them back in March. With that, I think I should pass on now to Ed. Is next slide?
It is indeed.
Ah, there we go. Thanks.
It is indeed me. Hello again. Well, with Chris's discussion about Mr. Ackerman, this part of the presentation also feels like going back to another era, and the closeout of the ISDA master agreement. It's perhaps one of the rather mundane areas, and in some ways to do with derivatives. But I would guess that there is no more expensive mistake that an institution can make rather than failing to close out its derivatives over a long period due to an error incorrectly giving notice. And this first came up as a major issue back in 2008, and I'll just drift into an anecdote about that time. Just after Lehman had become bankrupt, at Mayer Brown we gave a seminar to the market. A lot of hedge funds attended, and we were discussing how to close out the ISDA master agreement. And I said to the audience, well, of course, if you send a fax to close out the ISDA master agreement under the 1992 agreement, well, that's not a valid method of termination, and all your trades are still live. And even if you send that fax out under the 2002 agreement, well, that is valid, but you have to show that a responsible employee has received it in legible form, and people are doing some awful things like taking fax paper out of the machine or turning it off. So at the break time, two gentlemen came up to me and said, what exactly did you mean by that? And I pointed it out in the ISDA master agreement, and they went ashen-faced, and I saw them. I never found out who they were, but I saw them running ashen-faced, jumping in a taxi and running back to the office because they thought they'd closed out their trades, and they hadn't. And I think most institutions and most lawyers really got on top of what do you need to do, what are the nuances. There was a case back in 2014 which had ruled that electronic messaging systems do not include email, and that was, although you can't close out by electronic messaging system, you can extend the terms of extendable swaps, and that had quite a big effect. So why has this suddenly become so much more relevant under COVID? Well, it's much more difficult to close out an ISDA master agreement if your fax machines probably aren't even in many offices anymore. Certainly when I have showed the picture of a fax machine in the slide just now to some of our more junior lawyers, they feel like I used to feel when showing a picture of a telex machine. And so if you can't terminate by email, you can't really terminate by fax anymore. How can you terminate? Well, what we've always advised is make sure you've got people on the ground, go around in person, send a paralegal, send a lawyer in the local jurisdiction if it's an offshore jurisdiction, and make sure the agreement gets properly closed out. Well, with COVID, this became more of an issue. What happens if there's a lockdown in the particular area? What if the building's closed and the counterparty has only has a floor in a multi-occupancy building? Would it be sufficient just to hand that notice to the particular security guard? Well, probably not. And there was a paper out by ISDA saying, well, perhaps there's an implied term that it was argued for, that perhaps there's an implied term that allows other methods of delivery if none are possible. Well, it's a very tough argument. I think it's been overruled at first instance, but certainly not later down the line. And I think a prudent counterparty can avoid some of those problems. For example, certified mail is a valid form of termination if delivery is attempted. So when we were advising one counterparty caught in these in this sort of circumstances at the start of COVID, we suggested that a same-day certified mail arrangement was done in a particular jurisdiction by sending the notice across to a local agent who then arranged for delivery to take on a same day basis. And what we said was you don't want to be that test case as to whether or not implied terms work. So if we could just go to the next slide, please, and you can see the form of event default notice. It's very important to make sure you still have your event of default notice in the proper format to make sure these things are as far as possible delivered in person. And I'll move across to the next slide, please. And just to be aware of these weaknesses that can arise in COVID times. Now, of course, restrictions are lifting and they're lifting globally. But if a second wave of COVID comes, there may be the same problems, and there may be more accompanied by a greater number of events of default and similar under the ISDA master agreement. So we stress it is very important. Get advice as to how that's the best way to terminate an ISDA master agreement, particularly where it could be in a multi-occupancy building, or the closeout could be in a jurisdiction where travel is not particularly easy, or there's a complete lockdown. But COVID means this needs to be focused on even more than before. So with that, I will make over my hand over to the next section, and that goes across to Patrick.
Yeah, and a final word on closed default management under the German master agreement. Yeah, I refer to the new versions of the DRE and the clearing master agreement. There has been a change to termination notices that can also be, that must be in written form. There has not been a change, it's still in written form. To remember, termination must be for material cause, and there are just two examples. What is the material cause? It's a non-payment for 3 working days or non-delivery of collateral within 1 banking day. In all other cases, a material cause has to be justified. So bad rumors at all doesn't help. To get out early of the master agreement. So it's a difficult test to close out the German master agreement if there's not yet any non-payment. If there's not yet a default in collateral provision, but it's definitely clear that maybe the counterparty is insolvent, but it's not officially insolvent because of, for example, in Germany there has been a change in law during this COVID-19 pandemic that enables counterparty to postpone the opening of insolvency for 3 months. So it might be a difficult test in such a circumstances that needs to be verified cautiously if termination should be sought for other reasons than non-delivery and non-payment.